Good evening, everyone, and welcome to the second edition of our podcast, Financial Behavior. Today, we'll be talking about inherited IRAs, especially from the non spouse beneficiary standpoint. There's a lot of opportunity for planning and also tax considerations when you're either on the giving end or the receiving end of an inherited IRA. So, we'll spend a little time today talking about the changes that Secure Act 2.0 made to the law in terms of how non-spouse beneficiaries have to handle the assets they've received. We'll talk about some tax planning and tax effects of the giving and receiving of those assets, and then some planning opportunities on how you can handle distributions going forward of those assets and maybe what's the best strategy for you going forward. So again, we'll begin by talking about the giving and receiving of inherited IRAs. We're going to review Secure Act 2.0, some tax considerations, and planning opportunities. So let's look at the old rules. So under the old rules, a non-spouse beneficiary could cash out the IRA by December 31st of the fifth year following death. The biggest change is number two. Under the old rules, we were able to take that IRA and stretch it over that beneficiary's lifetime. Everything else is pretty much the same in terms of you can disclaim the assets still, you can cash out immediately, you can take your required minimum distributions over the oldest beneficiary's time frame. But the biggest change with Secure Act 2.0 is that now these beneficiaries essentially must empty out the account within 10 years. So with that, we'll talk about the planning opportunity on the end of how you may want to unravel those funds. But before we get to that, we're going to take a look at a case study in which we examine the beneficiaries as they are set up in the first place, and what are some of the tax ramifications of how we divvy up the funds that many of us may not even recognize will take place. So here we have a case study in which we have three beneficiaries. The total amount coming from the IRA is $150,000. So the thing that most of us probably don't recognize is the beneficiary and what tax bracket each beneficiary is in. So in our example here, we have three beneficiaries. They're in three different tax brackets, as you can see, 12%, the 22%, the 32% tax bracket. The one in the lowest tax bracket, if they were to cash out immediately, they're $50,000, they're going to receive 44 after taxes. The one in the 22% bracket will receive $39,000 after taxes, and the one in the 32% bracket will receive $34,000 after taxes. So the total giving after taxes is $117,000. Now, what if we were to want each person to receive the same amount of money? Well, we'd have to change the beneficiary designation such that the one in the lower tax bracket would actually receive a lower designation of funds, and the one in the higher tax bracket would have to receive a higher designation of that $150,000 for each of them to receive $38,570 in this case. Now, as you'll see, the total received is a little bit lower, $115,710, by trying to make each person receive the same amount equally based upon their tax brackets. So again, that's something that we generally don't really think about when we're naming beneficiaries. We simply name them because we want them to be equal. We've got two kids, we make them 50-50. We've got four beneficiaries, we make them 25 each. But these tax considerations become real in what you're actually netting to those clients. Now let's talk about a third scenario in which maybe the one who's more well off in the higher tax bracket says, I don't want the assets, I'm going to disclaim them. So in that situation, a disclaimer of assets can be sent to the custodian who has the funds and say, hey, beneficiary number 3 does not want these assets, and give them to beneficiaries 1 and 2. Well, in that case, now we're 50-50 with these people. Beneficiary 1 receives $66,000 of the $75,000 given, and recipient 2 nets out 58,500. So the total now becomes 124,500 versus the $117,000 we had before going. So again, planning considerations of those who have the assets now may want to look just one level deeper into how each family is operating, what tax bracket they're in, such that we can maximize the amount of those funds going to those beneficiaries. Next, we're going to pivot to some planning opportunities for those on the receiving end of these funds and how is it best to take those funds over time. So one strategy is the delayed distribution. That usually works for people who have no immediate need for the funds. They can allow the funds to sit there and grow, and again, just have to empty out the account within 10 years. This is also ideal for the inherited Roth IRA because once you inherit that Roth IRA, you can let it sit there and grow. And again, when you empty it out, there won't be any tax on those funds. So that's the ultimate planning opportunity there is the delayed distribution, especially on inherited Roth IRA funds. The next one could be a gradual distribution. And this generally works for people generally in lower tax brackets. They have moderate income, may or may not have a need for the assets. But again, taxes come into play. So the step one tax concern is to take distributions up until that level in which you keep yourself in that same tax bracket. So we don't want to spill over from a 22% bracket to a 24 or maybe a 24 to a 32. So we want to make sure we're taking funds only up to that tax bracket. The second person may be the self-employed person or their income varies from time to time. So in leaner years, when they've not made as much, again, they could take more of a distribution in those years, again, up to that tax bracket. And maybe in heavier years when they've done well, take less of a distribution. So that's kind of the theory there is, again, we're trying to manage those taxes. The third scenario becomes where you don't need the money, but you go ahead and take it. It's almost like you're doing a Roth conversion. You go ahead and take the distribution up to your tax bracket and immediately reinvest it into a taxable account or maybe a Roth, so such that we can create some tax-free income down the road. The final approach could be kind of a blend of the two strategies, where your income level is predictable. So again, you need like to take each year up to that level of your tax bracket again, not to go over to the next bracket. Or it could be where you're going to be retiring within this 10-year frame. So you have income that you're receiving from your employer, and maybe I'm going to go from the 32% bracket to the 22% bracket in retirement. So you wait until that event happens, your retirement, and then take the distributions. So again, we're trying to manage taxes and maximize how we inherit these IRAs and use these funds. So again, thank you for taking the time to watch the presentation here on the inherited IRAs. Of course, we're here for any questions you may have to help you through that process. And we'd like to wish everyone a happy Thanksgiving. Enjoy. Take care.